Hello, everybody. I want to welcome you to our first edition. I'm your host, Who's Your Loan Daddy. I'm here with at Snapback CPA, Stephen Gabrielson. Today, we're going to talk about some tax strategies, a little bit more about Stephen, what he does, what his business is, which is creative advising. He's not just a CPA. He's the most handsomest Snapback CPA I've met in my time. But Stephen's going to talk about a little bit about his business, what his niches are, how he creates specific plans for his clients and his customers and partners, and also creates tax strategies to help minimize taxes. Nobody wants to pay taxes. We have to pay them, unfortunately. There's two things that are certain in this life, which are death and taxes. I'm sure you've heard that.
Many times.
But I wanted to invite Stephen in. Stephen, welcome to the show. It's great to see you.
Thank you for having me. Stoked to be here.
Hey, we gotta bring in the best. What I wanted to do today is talk a little bit about what your company is, which is creative advising.
Yeah.
I know you've got a big social media following with your at Snapback CPA. Tell us a little bit about what you've done in the 7 years that you started creative advising.
Yeah. Thank you so much again for the opportunity to be here. Stoked to be here to chat with you about taxes and finances and the mortgage process and stuff like that. Really exciting stuff. But my name is Stephen Gabrielson. Been the owner and operator of Creative Advising for the last 7 years. I've been a CPA for about 11 years now at this point.
Oh, wow.
So I've been in the game for a long time. I've been blessed to have been trained by some awesome CPAs that taught me a lot about the tax code and a lot about different strategies that you can execute with clients and stuff like that, which kind of led to the foundation of creative advising, which is not necessarily just working with our clients to crank out a tax return and you talk to us once a year. We actually work very closely with our clients throughout the year. Every client that we work with, we are meeting with them at least quarterly to go through their overall tax strategies, go through their financials, estimate how much we think they're going to make during the year, and then talk about some strategies that we can take advantage of to reduce or even hopefully eliminate their tax liability throughout the year. Most of those strategies revolve around small business and real estate, actually, which obviously is something that we're going to hit on very heavily here today.
Yeah.
So, we're not like a traditional CPA firm. We're very involved in our clients.
Okay.
And I really, truly believe that's what sets us apart from everybody else.
So you're better than H&R Block is what you're saying?
I would like to think so, that we are better than H&R Block.
Yeah.
But yeah, there's the CPA world is a very interesting world. And I do think we do a great job in setting ourselves apart.
Okay. Tell me about that. Why is it interesting? What sets you apart from every other CPA, in the Treasure Valley and so on and so forth? Yeah.
So the CPA world, when you're talking about CPA tax firms, you basically have four different types of firms. You have a small firm, also known as like a small practice, right?
Okay.
Where it's one, maybe two CPAs that are very involved in the day-to-day activities of the practice, right? They're the ones signing the tax returns. They're the one doing all the client meetings. They're the ones preparing tax returns a lot of times. So that's the first level of CPA firm that you'll typically have, mostly small local mom and pop shops, right? The second is what's called regional firm. Usually they're in 3+ states in a certain region within the country. They're larger, they're well known. Most of the time their growth strategies have come from acquisition of other CPA firms.
Got it.
So they buy up a lot of those small mom and pop shops and they grow their client base through that. Still a combination of churn and burn tax return style of accounting firms.
Right.
They usually will also do audits and stuff in there as well. But typically what happens is when you're working with a firm like that, you're working with a partner who it's still the same type of thing. They're cranking out tax returns all day and stuff like that. The fourth is obviously the big four, right? The big four is your Deloitte's, KPMG, E&Y, those types of firms. Which are very, very high level. They do pretty much everything under the sun.
Okay.
And they work for the biggest, largest companies in the world, obviously. The fourth is like kind of a unique one that not many people know about. It's called a boutique CPA firm, where a lot of the times they're niched down, however you like to say that, in a specific industry, right? And they're very specialized in what they do, and they provide a higher level service to their clients.
Okay.
So that's where we kind of sit. We sit in that boutique style where we lean heavily on technology. We work with clients in all 50 states. We're not tied to Boise.
Okay.
And actually our client base is largely outside of Idaho at this point.
Really? Okay.
Which is kind of interesting. But so that's more of the boutique style where we're much more involved in our clients, much more hands-on. And yeah, like I said, we specialize more in that real estate, small business realm.
Okay. So let's talk about the real estate side of it. I know you
Yeah.
and I, before we got started, we chatted a little bit about, strategies, specifically like 1031 exchange.
Yeah.
For anybody that doesn't know what that is essentially, let's say you have an investment property, you've owned it for 4 or 5 years, you purchased it at an acquisition cost or a purchase price of $400,000. Well, now you made, a couple $100,000, you just sold it for $600,000. Okay. So you've made a $200,000 appreciation.
Yep.
1031 exchange is where you take the net proceeds and you do what with it?
Yeah, great question. So this is only for investment properties, right? We can't do this with individual personal primary homes.
Right.
So a 1031 exchange is a great example of a strategy that you can use to avoid having to pay that capital gain tax on a sale of an investment property. And like you were saying, you take the proceeds from that sale and you roll it into another purchase, right?
Okay.
There are very strict timelines around the 1031 exchange. After you close on the first house, you have 45 days to identify up to 3 properties. Then 180 days to actually close on one of those new properties that you identified within that 45-day window.
So meeting with somebody like yourself,
Yep.
people need to know the timelines, because if you don't
For
make
sure,
the timelines,
for sure.
now you could potentially have a tax consequence of
Yep.
$200,000 that you can't get out of just because you forgot.
Exactly. There's a lot of timelines that go into those.
Yep.
There's also a lot of other complexities, like identifying up to 3 within that 45-day window is only one of the options. There's 3 or 4 other options that you can run within that 45-day window.
Right.
So there's a lot of different nuances that come with 1031 exchanges. And making sure you're working with someone that knows what they're doing is very important.
I agree, for sure. So that's why it's important to work with a professional that knows what they're doing, that is extremely experienced, and that has all the resources and a great team to make sure that we don't leave money on the table. We also minimize your taxes as much as possible, because again, nobody likes to pay it. Another thing that we talked about was depreciation.
Yeah.
So that's one thing that a lot of self-employed people and people that are higher income earners
Yeah.
need to make sure that they know how to use it to their best ability and to their benefit to, again, minimize taxes. So tell me a little bit about, or tell everybody a little bit about depreciation and how you use that as a strategy.
Yeah, great question. So again, depreciation, this is mostly on the investment side.
Right.
From a primary residence perspective, unless you're using an area of your home like a home office, that's 100% dedicated to the running of your small business. If you're W-2 and you work from home, that doesn't constitute a home office in your home. But if you're a self-employed individual and you're working from home in an office in your home, you can utilize depreciation in that sense from a primary residence as well. But the easiest way to describe depreciation to somebody is like buying a new vehicle, right? Everyone can kind of wrap their mind around that. When you purchase a new vehicle, typically what happens is you drive that vehicle off the lot, it immediately drops in value, right? As you use that vehicle more and more and more, that asset value goes down over time. And that's what we call depreciation, right?
Right.
Typically, when you have a bigger purchase, like a vehicle or like a home, the IRS does not allow you to write that all off in the first year that you buy it, right? The reason is because it's called a capital expense. Sorry, not the IRS. Actually, the accounting rules don't allow us to write off that expense in the year that you buy it, because it's called a capital expenditure, right?
Okay.
Every single asset that has a large purchase value like that has what's called a useful life. Usually those useful lives are around 5 years, 7 years, 10 years, 15 years, 27 years, 39 years, depending on the type of asset that you're buying.
Okay.
So real estate is really unique, right? Everyone knows when you get into real estate typically goes up in value, not down in value, right?
Yeah.
Theoretically.
We hope.
Exactly. And so what's unique about that is as you buy a rental property, it goes up in value as you own it, but you're still able to depreciate the actual physical asset, the house itself, over a certain useful life.
Okay.
There's a lot of strategies that we can dive into and get into the nitty-gritty details of that through like cost segregation studies or other strategies like that you can actually accelerate portions of that depreciation and create a larger deduction and a larger expense in that first year, which the IRS actually does allow you to do. A lot of vehicles, the same situation, right? The IRS will allow you to write off the entire cost of certain vehicles in the first year that they are placed in service within your business.
So let's talk about that. So I get a lot of questions from my clients. Hey, I want to lease. I want to buy. What do I do?
Yeah.
And again, I always say that's a great question.
Yeah.
Depends.
Yeah.
Just like every loan is a snowflake, every person's tax situation is a snowflake, in my opinion, just based on experience. But tell us a little bit about, if I'm a self-employed person, I'm a, I file a Schedule C. I've been self-employed. I have a primary home, maybe a rental, maybe a second home.
Yeah.
And I want to chat about do I lease and
Yeah.
this 6,000 pound rule.
Yeah. So we're talking vehicles.
Vehicles specifically.
Yeah.
Let's talk a little bit about the vehicle and ways people can use a vehicle to minimize taxes, or tell us a little bit about that.
Yeah. Great question. So
Thanks, Stephen.
we'll go back and forth between the two. Okay. We'll talk about leases and we'll talk about depreciation because they're two separate things.
Okay.
When you lease a vehicle, you're not able to depreciate the vehicle on your tax return.
Okay.
Okay. So you're not able to take, if you qualified.
So no double dipping?
So no double dipping, unfortunately. I wish. It'd be sweet, right? So when you lease a vehicle, you still are able to take the full lease payments as a deduction.
Okay.
Right? So let's say you lease a vehicle $1,000 a month. You're able to write off that $1,000 a month payment on your business if you use that vehicle 100% for business.
Which we always do, right?
Which, yeah, exactly, of course. Which we should be tracking our miles throughout the year. We should be going through making sure that we're tracking all the expenditures for the vehicle. We're saving our receipts for gas, for all the repairs and maintenance, for all that stuff. We're tracking all of that, right? And we can take all those deductions based on the business use percentage of that vehicle.
Okay.
Okay.
What do you typically see percentage, like in general,
So
so that we don't raise red flags
Yeah.
or issues?
Yeah.
What's a good in
Great-
general?
Yeah, great question. So real estate agents, for example, kind of fall into this category more than other professions just because they're driving so much. They're driving a lot.
The good ones are
The good ones, exactly, the busy ones. Well, a lot of times what they'll do is they'll have one vehicle that they use specifically, strictly for clients. They'll have a nicer vehicle that they drive around clients. Maybe they have kids. They have another vehicle that they use for family stuff, right?
Yeah. No Cheerios on the floor.
Exactly. So it's a cleaner vehicle. It's always nice, always kept up. That vehicle would be 100% business use,
Okay.
right?
Got it.
Now, if they don't have a second vehicle, and let's say they have a lot of kids, they're going on sporting events, stuff like that, you might most likely see a 60 to 85% business usage from that vehicle, right? So it really depends. And the actual tax law requires you to keep a mile log.
Okay.
So you have a very accurate depiction of what the business versus personal use is.
How many people do that?
It's
Like if you said, "Hey, show me your mileage log," is it like, "Oh, I should probably create one now"?
Yeah,
Is that what
I
you're
mean,
saying?
the thing is, a lot of times it depends on the CPA you're working with.
Right.
We require all of our clients to do it. So if you're writing off a vehicle, you have to have a mile log that
Cover your
shows
butt.
your miles between personal and business use. Because at the end of the day, it all comes down to whether or not you get audited. If you don't keep a mile log, that doesn't mean you can't write off the vehicle.
Right.
Right. It just means that if you get audited, you're going to have a very hard time proving that business use percentage that you put on the tax return.
Gotcha.
So that's really what it comes down to. We've seen it in court cases where we've had individuals where they haven't kept mile logs, but they can go back and kind of rebuild them based on the MLS data for what houses they showed, the mileage to and from the different places, and you can kind of recreate it. It's a lot of headache,
a lot of extra
a lot of
heartache,
pain. You'll
Stress.
lose sleep at night hoping you can
Just get it
pass it, especially if you're dealing with a larger, more expensive vehicle.
Yeah. And there's apps and things. I've seen a lot of people use an app. It's very simple. It keeps track of your mileage.
Mile IQ is
it
one.
done.
It's like I always call it Tinder for vehicle mileage. You swipe right for business, swipe left for personal.
There you go.
Super easy to use.
Okay. What was the name of it?
It's called Mile IQ.
Mile IQ. Okay.
No plug. I don't get paid for that.
Yeah.
I wish I did, but I don't.
At Mile IQ. What's up?
Yeah, there you go.
Yeah.
Just a little shout out for
Yeah, a
free.
little shout out.
So that's on the leasing side, right?
Okay.
Always track mileage. From the depreciation standpoint, you still want to make sure you're tracking your mileage always. When you actually purchase a vehicle, there are a lot of rules and nuances for how depreciation works. Okay. When I say depreciation in general depreciation is depreciating a vehicle over its useful life.
Okay.
Which means 5 years typically for most vehicles.
Okay.
Okay. So if you buy a $100,000 vehicle, take it by 5, it's $20,000 a year.
Okay.
If I'm doing my math right.
Yep.
And so when it comes to accelerating that depreciation and taking it up front, there's a lot of rules for different types of depreciation. A very popular one is called Section 179 depreciation,
Okay.
which is very different from bonus depreciation. A lot of times car dealerships like to slam those two together and they say, hey, come buy your new Range Rover. It's over 6,000 pounds. You can write it off through Section 179 depreciation, which is completely false.
Okay.
Section 179 depreciation has much more limitations and strict rules around it. Not only does the vehicle need to be larger than 6,000 pounds, gross vehicle weight rating, GVWR.
Wow, it sounds like you've done that before.
Yeah, right.
Yeah.
It needs to be over 6,000 pounds gross vehicle weight rating,
Okay.
which again, GVWR. It's on the inside of the door panel. You can also Google it, and you'll get a range for your type of vehicle and year and make and model and all that
So it
stuff.
has to be over 6,000.
Has to be over 6,000 pounds. Not necessarily for Section 179, but Section 179, the rules are if it's over 6,000 pounds and it's not a truck that has a truck bed of 6 feet or longer and a nose that sticks out more than 3 feet, it only can qualify for up to $25,000 of a deduction.
Total
So if you,
over the life or just a one
just
time?
the first year, just the first year.
Okay.
You still get to take the remainder over the next 5 years.
Okay.
But if you buy a $100,000 Range Rover, right, it's over 6,000 pounds, and you try to Section 179 depreciate it, you're only gonna be able to take $25,000 in the first year.
Interesting.
Okay. Now this is where bonus depreciation comes in. That's why it's become so popular since 2017. When Trump first took office back in 2017, he did the Tax Cuts and Jobs Act, which bumped bonus depreciation up to 100%. Bonus depreciation does not have as many rules and limitations on it like Section 179 depreciation does.
Got it.
Bonus depreciation allows us to take the entire deduction or the entire cost of an asset if it has a useful life of 20 years or less, which a vehicle does, but there are more rules for vehicles. So if the vehicle is over 6,000 pounds, you are then able to take the entire deduction of the vehicle if you use it 100% for business.
Got it.
So if you have a Range Rover, $100,000, you do bonus depreciation on it, you're able to take that as a $100,000 deduction in the year that you place it in service.
Got it.
As long as it was purchased after January 19th, 2025, because it was starting to phase out. Now it came back.
Okay.
Bonus depreciation came back
And
to
that's
100%
just
this year.
so that kind of segues into our next topic,
Yeah.
which is going to be the big beautiful bill.
That's right, baby.
There's been a lot of chatter about the big beautiful
Yep.
bill, and you see all these YouTubers and social media experts. Wink, wink.
Yep.
I would love to hear your take on it, what it
Yeah.
is, how it can benefit people. So tell us a little bit about the big beautiful bill.
Yeah, I mean,
your
there's a lot of controversy around the one big beautiful bill for many different reasons.
Okay.
As a tax professional, I love the tax aspect of the one big beautiful bill. It gives us a lot of benefits there. On one hand, it does take away some tax benefits on the other side, and I'll go through those in a very general aspect. There's also a lot of political issues around the one big beautiful bill. It increases spending. It reduces a lot of the energy credits and energy efficiency things that were included in the tax codes before now. So there's a lot of political issues kind of around the one big beautiful bill. But from my perspective, I do love what it does for us on the tax side. The first big thing that it did is it brought bonus depreciation back up to 100%.
We're back.
So we're back to 100%.
Okay.
Which is great for real estate investors. It's great for people who buy a lot of assets in their business. It makes it very easy to take those deductions and reduce your overall tax liability, which is awesome. So you'll see a lot of reinvestment back into real estate, into equipment, into a lot of things to help run businesses and stuff like that, into infrastructure.
Promote spending. Yeah.
Promote spending.
And good
Exactly.
and buying good debt.
Exactly.
Okay.
Kind of on the flip side, what it did is we have what's called 45L, and we also have Section 179D, which are two energy efficiency credits for purchase. When you buy a investment property, you a lot of time before this, you would be able to do energy efficiency improvements, right? Certain types of windows,
doors,
certain
stuff
types of HVAC stuff, certain types of insulation, that type of stuff that would allow for additional credits on top of the depreciation aspect that you're able to get from the buildings. That phases out in 2026. So we're losing a lot of those energy efficiency programs. Still not a huge deal for a lot of people. The fact that bonus depreciation's back is really exciting for most smaller investors.
How long has it been since it's been back? Like when?
So it started phasing out in 2022.
Okay.
2022, it went to 80%. Or is my thing about that right? 80%. Yeah, 22, it went to 80%. 23, it was at 60%.
Wow.
Actually, no, that's not true. 23, it went to 80%. 24, it went to 60%.
Okay.
25, it was scheduled to go down to 40%.
Wow. So now it's at 100.
So now it bumped back up to 100%.
Nice.
So if you placed your asset in service between January 1st and January 19th of 2025, you're stuck with the 40%.
Gotcha.
So
So hopefully
Yeah.
you've bought after the 20th of
Yep.
January of this year, and you'll be fine.
Exactly. The other thing it did on the personal side with the One Big Beautiful Bill is it did increase the SALT cap deductions.
Yeah, we were talking about that.
During his first term back in 2017, the Tax Cuts and Jobs Act actually put a cap on how much you were able to take from a state and local tax deduction as an itemized deduction on the Schedule A on your personal tax return, which hurt a lot of people that pay a lot of state taxes,
Sure.
either property taxes or state income taxes.
So a lot of investors that own multiple properties or higher income earners.
Exactly.
Okay.
From the investment standpoint, you were still able to take the property tax against the rental income from the property.
Okay.
So you weren't limited from that perspective, but just like the leftover stuff. So like I said, the state withholding, property tax on your personal residence, that type of stuff was limited. And so with the One Big Beautiful Bill, it went from 10,000 all the way up to 40,000.
Wow.
So we have a bigger cap on that as well.
That's a times 4x.
Yeah. Yep. So they bumped that up.
4. Okay.
They learned their lesson. They listened to the people on that one. They bumped it
well,
back
that's
up.
good.
Yep.
That's a good thing. So that brings me back to my next point, which is going to be self-employed, clients for you, homeowners or home buyers for me.
Yeah.
I come across a lot of self-employed people that, really struggle with being able to qualify,
Yeah.
especially with the prices in the Treasure Valley rising.
Yeah.
I think the
Not only
average,
that, it's a rough process
Yeah.
when you're self-employed.
if I'm an investor and I want to buy a single family residence anywhere pretty much in Treasure Valley, I mean you're at 5, 6, 100,000 plus. Sometimes when I get a tax return or if I need to use a 2-year average, depending on the situation, if I have a 2-year average and the income is not anywhere close to qualify, that leads us to a problem where people are having the affordability crisis. So I do a lot of loans for self-employed people that cannot qualify in a tax return. Like I get their tax returns and it's like, that's not happening.
Yeah.
We also get to use the rental income off the subject property to qualify. Sometimes that's not even enough.
Yeah.
There are tons of different programs out there for self-employed borrowers. As long as you have 20% down or more, you're going to be able to qualify for what's called the DSCR loan. DSCR stands for debt service ratio or coverage ratio, which essentially means we're going to be able to use the rental income off the property. I don't need tax returns. It's literally an appraisal, a rent survey, an appraisal, and as long as the rental income is close to the PITI, PITI stands for principal, interest, taxes, and insurance, the total monthly obligation on the property, as long as those average or are super close, can even be less in some situations, which we can go over, we can do that loan. So, for instance, I have several clients that have sent me tax returns they want to buy, and I'm like, I really want, I think, you definitely qualify, but not on paper.
Yeah.
So what we do is we look at going the DSCR route, which is a great program for some. We also look at bank statements. So I can take a 12-month history from a self-employed borrower. We take the last 12 months. We look at all the deposits, and we typically take 50% of whatever the deposits are on average over a 12-month span. We take out any one-time deposits that aren't normal and common and standard. And then we come up and are able to qualify based on that average. So I've been able to approve multiple clients, higher end loans, like $1 million, $2 million in loans, because they have the down payment, they've got the credit, they just can't qualify in a tax return. And the interest rates are not that crazy.
Yeah.
Traditional rates right now are somewhere in the mid to high 6s for a traditional conventional 30-year fixed mortgage. You're going to be somewhere in the very low 7s, sometimes even high 6s for a investor type loan. But again, each situation's different. Cool. So tell me a little bit about, we talked a lot about self-employed borrowers. A lot of people think that, I can't buy a house. I don't have any income on my tax return. Well, you can. Yeah. That's why you want to talk with a great, mortgage professional and advisor that has access to programs. As a mortgage broker, I have access to pretty much every lender program in the entire country with every single lender. So if you have a heartbeat, you have great credit, and you also don't even have to have great credit at sometimes. There's times where I get clients that come in and they're just like, I don't know why I'm meeting. I was told to come to you. But at the end of that conversation, we really peel back the onion, which it sounds like you do with all of your clients. You really need to peel back that onion.
Exactly.
Let's look at cash. We're going to look at credit. We're going to look at income. Well, some people came to me recently and said, hey, I want to do a reverse mortgage. Well, that's great. We sat down and we really assessed everything. And I went through my checklist and we dove deep. At the end of the day, they didn't even end up doing a reverse mortgage. It didn't make sense to them.
Yeah.
Everybody would love to not have a mortgage payment, but we did the math, we did the computations and calculations, and we decided, look, the numbers didn't pencil. It didn't make sense. It didn't make sense for their next of kin. So when they were to pass, all of that money that they would have spent on a negative amortization loan, it just didn't make sense.
Yeah.
So you really need to work with a trusted advisor that knows what they're doing, that knows tax code, that knows strategies, that has been there and done that and worked with multiple complex situations. I come across complex situations daily.
Yep.
You need to be able to quickly pivot and have a great team and a great, a bunch of resources around you to make sure that if and when things happen, we've got solutions. So, that's pretty much what our job is to provide solutions on a daily basis.
Yeah, absolutely. And to add to that,
Yeah, please.
a lot of times, a lot of CPAs out there will just try to reduce that net income number as much as possible.
Yeah.
Right. A lot of times clients do it, right? They want to write anything and everything off under the sun, whether they can or not.
Yep.
Which is another issue. But they don't want to pay taxes more than anything, so they just drop that net income as close to zero, below zero as they can, right?
And then they go and buy a car right before they buy a house.
Exactly.
And they come see me and I'm like, what are you doing?
Exactly. And so it's a lot of times when you're working with a CPA that doesn't also understand the lending process or what you're trying to do long term, you can really hurt yourself in that situation from qualifying for loans going forward. And so with us, obviously, we work with a lot of investors. We understand what the long-term goals of a lot of the clients that we work with are. So every time we're completing a tax return, we make sure that we're setting it up in a way where they're not going to destroy themselves come lending, right? And so within the tax code and within the mortgage lending process, right, your biggest number one goal is cash flow. You got to find out what that monthly cash flow is to make sure that they can handle the debt to income ratio or whatever it is, right?
Yep.
What's cool about that and what that allows us to do on the tax side is you have certain add backs, right? Depreciation, which we hit on a lot, is a big add back.
And we can use that for qualifying income.
Exactly. So you take a $150,000 depreciation deduction from this investment property that you buy, you wipe out $150,000 on your tax return. Maybe you show zero income on your tax return, but you're able to take that to your lender. And if your lender's good, he knows that's going to be an add back, and you're actually still able to show that 150 of income.
100%.
Right?
Yep.
So there's a lot of strategies that you can run on the tax return that help you save on taxes, but still keep you lendable.
Right.
So you got to make sure that you're working with professionals on both sides that understand that process. When you finalize your tax return before you submit, make sure you give it to your lender for approval, make sure it looks good. Yeah, so there's a lot of dirty, hairy things that I've seen people do in the past or try to do within the lending process that a lot of people will fall into mortgage fraud on, which I don't know if you're wanting to jump into that, but we can talk a little bit about that. I've got some crazy stories about that.
Tell us about that. I'd love to hear what people have tried to do that you're like, not happening.
The most common thing that we get is
can you amend a tax return?
Yes, it's exactly right.
Wow.
Yep. So
hey, can you change this to look like this?
Exactly.
Right? Tell me
so
about
the
that.
worst thing that we always see is clients will come to us and be like, hey, I don't want to pay anything in taxes, but I got to get these taxes done so I can get this house. So let's just run these numbers, run this tax return, and then we'll amend it afterwards.
Sounds like a no.
It is the worst thing that you can do. That is the number one red flag or whatever you want to call it for mortgage fraud.
Yeah.
We see it all the time. People try to run it all the time, and it's not a good way to do it. You show your income high, and we take out all the expenses. You file the tax return. You pay that tax, and then you go back and amend the tax return and reduce that net income from $400,000 all the way down to $100,000. It's very clearly mortgage fraud.
Right.
So
lenders,
a lot of issues with that.
Yeah, great point. That's crazy that that's still happening.
Yeah.
A lot of lenders are out of business because of that.
Yeah. A lot of CPAs as well.
If your lender tells you what he just said, you might want to look elsewhere.
Yeah.
Because that's
run for the hills.
Yeah. It's just not a matter of if, it's a matter of when you're going to get caught.
Yep. And the thing is, not only you go to jail for mortgage fraud.
Yeah.
The CPA goes to jail. The mortgage lender typically goes to jail.
Not
a lot
happening.
of people go to jail.
No.
Yeah.
No, I've been doing this for 26 years. You're 11 years into this. I have no plans to.
I don't look good in orange.
No. Well,
yeah.
Giants like orange and black, San Francisco Giants. Shout out my Giants. I do get that question where they say, hey, how much do I need to make? Where they say, hey, tell me what I need to make. That's not up for me. Mm-hmm. As a self-employed person, you are to work with your CPA and your tax strategist.
Yep.
Preferably Snapback CPA, Stephen. But at the end of the day, it needs to jive.
Yeah.
You can't make up a number that you can't prove, because if you get audited and you can't prove it, guess what?
Yeah.
They coming after you.
Yep.
What are some of the repercussions of somebody that files a tax return that turns out to be bullshit?
Yeah. There's a lot, and it depends on how bullshit it is, right? If you have, so first off, any discrepancies that you have, if they come in and they look at it, and let's say they find $20,000 or $30,000 of deductions that you should not have taken, right? What happens is you owe an additional tax. Based on that, you'd probably owe $5,000 to $10,000 of additional tax, right?
Okay.
You'd have penalties and interest associated all the way back to the time where it should have been paid. So you have to repay the IRS those amounts. You have to then go through the audit process, which is brutal. If that $20,000 or $30,000 is a 20% change in your overall tax liability, what they will then do is they will go back 7 years and try to find more for the last 7 years.
They'll dive deeper into it.
Yeah.
Well, let's see what else we can find.
Yep. So how all audits typically work is the IRS agent will sit down, hopefully with your CPA,
Right.
and they'll say, okay, these are the accounts that we're looking at. Get us the what's called the GL for this, the general ledger,
Okay.
which basically is just like an itemized list of all the transactions that happened within those accounts. And they'll go through that list and they'll say, okay, give me this one, give me this one, they'll just pick like random ones throughout the
Just
list.
like a random.
Yeah. And if you can furnish those receipts and give them to them, they're like, okay, this is pretty clean. Like they have their stuff's in order. It's probably pretty clean. They'll wrap it up and they'll probably be done. If you can't furnish those receipts, they'll say, okay, give me this one. They'll start going through the list.
Now we're really going to have.
Now they're really going to go down the list, right? So they're
luck
going to go
sleeping at
deeper
that
and deeper
point.
and deeper and deeper and deeper. Yeah.
Wow.
So it can get pretty hairy pretty quick.
Yeah, I'll bet.
But it also depends on what kind of auditor you get. The IRS is an absolute mess. So while talking all about that is scary, we've also seen the other side of it where we have a client that gets opened up for audit, and then the audit sits for 6 months. You don't hear anything. You have an initial call with the auditor right when they get the letter, and they go quiet, and then nothing really happens, and all of a sudden you get a letter 6 months later after that 6-month window, so a year later, and it says, oh, we've closed your audit. And typically what happens there is the IRS auditor, you either quit or got fired or something happened. So we see that all the time within the world of the IRS as well. So,
when you deal with hundreds and hundreds of clients, I mean, you're going to come across crazy stuff. So
Yep.
that's interesting. I've never heard that perspective.
Yeah.
So.
And that's actually a client that came to us who was getting audited and switched over to us because they were getting audited from another client. So it's not our tax returns didn't spark the audit, but.
Gotcha. Well, you got to, But again, our job is to advise,
Yep.
make sure people are aware, don't skate the system. It's not a matter of if, it's a matter of when. Cover your ass.
Exactly.
You have to cover your ass.
Got it.
Cool. Now I want to talk a little bit about what I call myth or money move. Money move is, that makes sense. That's a great idea. Or myth, like, oh no, you can't do that. I get a lot of clients and I get a lot of questions from clients where, hey Jared, can I do this? I heard if you do the following.
Yep.
What are some things that you get questions and that are commonly asked that you have to dispel the myth?
Yeah.
Or like, no. One of them would be, can you just amend your tax return to qualify for a mortgage?
Yep.
We've already
That's
pretty
definitely
much
a big one.
debunked that. Definitely don't do that. What else are you coming across or hearing from your clients as of late?
I mean, you hear the wildest stuff, You hear writing off all sorts of things
Like
under
what?
the sun that would not typically be write off.
Horses?
So I haven't come across horses yet.
Okay.
It wouldn't surprise me if it's coming. And there are certain situations where you can't actually write off horses. There's situations where you can write off basically everything, right?
Okay.
The biggest things that we come across are luxury items, right? Watches, clothing, designer handbags,
But
nice
I use it
shoes,
for work,
fancy
Stephen.
shoes.
I use it for my work.
You use it for your work. I get that. But the thing is, the IRS says, and this is very, very specific within the tax code and very outlined in court cases, if you use it for any personal purpose at all, you cannot take it as a deduction.
So I can't wear it when I go out to Crave tonight for dinner
Exactly.
and with my hubby?
Exactly.
Not
So
me, with my hubby, with my spouse?
yes, with your spouse.
Yeah. I don't want to start any rumors.
Exactly. So the only time that would really make sense from a clothing perspective, right, is let's say you buy the clothing, and let's say you're a famous person. You buy a dress, you wear it on the red carpet, you do all your promo stuff, you take that dress and it goes into a shelf to never be worn again because you can never be seen in the same clothes twice, right? That's a situation where you probably could write that dress off, right?
You could write that off.
You could write that dress off if if that was your image and if you were using that to promote your business, then it was a very business specific thing, right? Another situation would be what a lot of people do is like self-branded stuff, like my hat, right? This is a deduction. This is a creative advising hat. I'm able to deduct this. I wear it every time I come to any business events like this.
Yeah.
Anytime I'm sitting down, I'm going and promoting. If I go to a conference, I'm wearing this hat along with a creative advising t-shirt. I don't typically just wear them out for personal use or anything like that. So a lot of times you'll see people, branding their clothing, stuff like that, which does make it more likely to do. But the biggest thing we always see is like luxury watches are so hard to write off and justify. Even if it makes you look good to your clients.
I spent $8,000 on that Rollie. What's up, Steve?
Exactly.
I can't write this off. I was in Vegas. I was on a heater. I got me a Rolex. It's for work. It's for work.
Exactly. Even if it makes you look better to your clients, even if it makes you like look more professional to increase your brand, a lot of times it still doesn't work.
Perception is not reality.
Perception is not reality. So that's one of the biggest myths that I see on there. There is a lot of there's a lot of, I don't want to say gray area, but a lot of wiggle room when it comes to what deductions you can and can't take.
Okay.
The IRS looks at deductions as anything ordinary and necessary to run your business, right?
Okay.
And so the way you got to look at it is, let's go to a vehicle, right? For a real estate agent. Is it necessary for a real estate agent to have a vehicle to drive?
Yes.
Absolutely necessary. They need it to drive their clients around to go to different properties, right? 100% necessary. Now, is it ordinary for a real estate agent to drive a Ferrari?
Depends on what part of town.
Yeah, and I might have those flipped. It might be ordinary for a vehicle, and is it necessary for them to drive a Ferrari? Right.
Right. Not necessary.
But the part there is maybe it's not, but maybe it is.
Depends on your
Depends on your clientele. If you're selling $30 million homes, you probably should be driving them around in a Bentley or a Rolls Royce, whatever it is, to look at those homes. Right. Because they're luxury. They need to see that. So that's the part where you have to apply it to your individual situation. You have to apply it to your individual business to make sure that you can actually take it. Right.
Gotcha. Okay.
Yep.
Cool. Cool. Another thing that I get a lot of questions on are meals and entertainment. What can I write off? A long time ago, I used to be able to write off meals and taking out clients and so on and so forth. But if I'm a self-employed person and I take my clients or customers out for, fairly expensive meals, $500 meals, that's very easy to do. Yeah. Pretty much anywhere.
Yeah, exactly.
If you take 4, 5, 6 people, $50 to $100 a person is very easy.
Yep.
What are the rules around meals and entertainment specifically as a write-off?
Yeah, great question. So meals is still deductible.
It is.
Entertainment is not deductible.
Okay.
That's what also shifted in the 2017 tax changes.
Okay.
So meals, you get 50% of your meals. Okay. Unless it's a meal where it's like you have a conference, and like let's say we brought a bunch of clients into a conference room, and we did like sandwiches or something that they could eat, or like box lunches or whatever. That would be 100% deductible meal in that situation. But if you take a client out to dinner, the IRS looks at it as you're paying for food for yourself and you're paying for the client. So they let you take half of it. They take the client's portion.
Gotcha.
Right? So you still can do that. Now, what a lot of people try to get away with is that a lot of people will try to say, hey, I'm working throughout the day. I go get lunch. I'm sitting by myself and eating lunch. This is a business deduction. That's not a business deduction. You're just feeding yourself throughout the day.
That's just lunch.
It's just lunch. Exactly. Yeah. Or a lot of people try to say, I go out with my wife and or my spouse, and we go out to dinner and we talk business the whole time. It's like, there might be certain situations where that makes sense, or maybe that makes sense for once a week or once a month. It doesn't make sense for every night.
And how much of that meal is booze versus
meat? Exactly. Yeah, exactly. Exactly.
Okay. Good to know. Okay.
But the entertainment portion, if you take your clients, it's gone. If you take your clients to Disneyland,
tickets. What about golf?
You take them to a yacht.
I'm a big golfer. You're a big golfer.
So the golfing stuff, I mean, that is the entertainment portions. What a lot of CPAs are honestly doing is they're shifting it from entertainment to advertising. Okay. Just because a lot of that stuff is you're there to generate leads, you're advertising, right? And so a lot of times it gets shifted into that bucket. So from that situation, I would probably still write it off as advertising, to be honest. Yeah. But there's some wiggle room in there. But like going to like Disneyland or taking them on a yacht, that kind of stuff is pretty clearly entertainment. Yeah. And those bigger ticket items are much harder to push through as an advertising expense.
When in doubt, check out Snapback.
There you go. There you go.
That's a great question. I don't know. Let's find out. Okay, cool. So on future podcasts, we're going to talk more in depth about cost segregation studies, what they are, how to make them work for you, how to take all the all the cost segregation analysis and studies. They're extremely complex. They're very time consuming, but they work, especially if you are buying multiple properties. I recently just have one of my, higher end clients just bought a multi-million-dollar property, sold 2 other primary residences, got married, all kinds of moving parts. Well, his CPA said, hey, you need to go out and spend $2.5 million to mitigate a $400,000 tax hit. So he's like, oh, I have to go buy things so that I don't have a $400,000 tax hit. Well, it makes sense, because why would you take a $400,000 tax hit just based on the fact that you sold properties? Well, no, go roll those into good debt, go buy investments, and use that money and kick the can down the road, so you don't have to pay Uncle Sam and Uncle Trump
Exactly.
all that money.
That $400,000 you pay to the IRS, you're never getting back.
Never.
If you take that amount, that $2.5 million, you go invest it into real estate. That $400,000 you invest it into real estate.
Yeah.
That's $400,000 you'll get a return on, and you'll see that in the future. So,
Plus the appreciation, plus the tax benefits of writing off the interest and a portion of the
Exactly.
Yeah. So again, work with a true professional that knows what they're doing. It's not an internet or some wanker on social media that is an expert. When you look him up, he's doesn't even have a good website. So, so we're going to get more into cost segregation studies. We're going to talk more about depreciation, self-employed, how to benefit from using your taxes, how to prepare for buying potential, multiple, rental properties, DSCR, bank statement options for self-employed. We're going to get more into 1031 exchanges. We're going to get into how to avoid capital gains on sale of departures. I know we talked about a little bit about that. I bought a house. Oh, perfect example. So I'm a first-time home buyer. I buy a house. I put 5% down. I live in the house. How long do I need to live in the house, Stephen, to be able to say, you know what, I want to buy another property?
Yeah.
What is
Great question.
What is the rule on that?
Yeah. So if you live in the house as a primary residence for at least 2 years, you get a primary residence capital gain exclusion.
Only as your first-time home, correct?
No, every 2 years.
It's just every 2.
Every 2 years you get this exclusion.
Okay.
So if you're single, that exclusion's $250,000.
Nice.
So if you buy a $300,000 home, you live in it for 2 years, you're single, you sell it the next year for $450,000, you do not pay, or if you sell it after 2 years, you do not pay any capital gain tax on the sale of that
single
property. If you're single.
Okay.
If you're married, it's $500,000. So same situation, you buy a house for $300,000, you're married, live in it for 2 years, you sell it after 2 years for $500,000. You're not going to pay any capital gains tax on the $200,000.
So this is your free get out of jail card. So if you need to, sometimes you're going to have to get married to avoid paying taxes.
That's a great way that people actually build a portfolio. So they move every 2 years. They keep that house as an investment property. And obviously you're not selling it, but
a realtor that we work with, you know who he is. He did that strategy where he literally bought his first house every 2 years, just literally every 2 years. And now he's got a portfolio of 10, 12 properties. He and his wife are happily married. They got 2 kids. The cost segregation studies that you've done for him and things to help build his portfolios has been great to see. So that was a great job on your part. So we're going to talk again, capital gains on the sale of departure, the sale of your departure residence. So when I say departure, that means I have a home, I've lived in it, it's been 2 years, I sell it. Whatever net proceeds that you get, meaning what the house sells for versus what you net after everybody's paid, whatever those net proceeds are, you're going to typically roll that into your next house, or you're going to use that to, invest in investment properties or what have you. So that's the one thing. Deductions you can take as an investor. We talked about that a little bit, but we're going to dive deeper. The depreciation aspect where we can use that too. So somebody that makes $300,000, $400,000, $600,000 or more, but has $250,000 in depreciation. Just so we're clear, if I make $600,000 and I have $250,000 in depreciation, guess what? Now you're going to pay tax on $350,000. So that is obviously going to significantly impact somebody's ability to not have to pay as much tax. So
absolutely,
that's the goal when we wake up, is to meet with Stephen. Hey, Stephen. I make a lot of money. I have a lot of rentals. What do I do? Once he develops a plan for you and develops a strategy, he's going to help you execute that so that you guys can minimize taxes, continue to build wealth, create wealth, and look for opportunities. And he can give you tons of advice on really just, looking for every opportunity possible to get your family, get your portfolio in order, get your family in a great financial situation. So
Yep.
definitely trust local professionals. Follow us. If you guys have any questions, we're going to be doing this on a monthly basis. If you guys have specific questions, hit us up. He's at Snapback CPA. I'm at Team Fazio or Who's Your Loan Daddy. We've recently come up with those, but we look forward to future podcasts with you, Stephen. I appreciate your time today.
Thanks for having me. This has been awesome.
We should
It's
do this
great
again.
to have your team of financial professionals around you. A good loan guy, good tax guy, good attorney, good financial advisor. It's important. So having a good team around you is absolutely important.
I agree. So with that being said, we'll see you on the next podcast, and thanks for your time.